Okay, so we all use money pretty much every day, right? Tapping a card, checking an app. But how often do we actually stop and think about what money really is, like fundamentally?
Exactly. It's not just about the coins or the numbers on a screen. There are these deeper forces, psychological, historical, that give it all its power.
And that's what we're diving into today. We're
hmm
going beyond the usual how to save tips, using some really great insights to understand money at its core.
Yeah, our goal here isn't quick financial fixes. It's about getting to the bedrock, understanding the psychology, the history that shapes how we even relate to money. It gives you a much richer perspective, I think.
Totally. So we're skipping the surface level. We'll start way back with the messiness of barter and trace it all the way up to, well, digital cash and everything in between. We want to hit the big evolutionary steps, but really focus on why these changes happen.
The underlying principles, yeah.
Right. So to kick things off, why did we even invent this thing called money? It wasn't just about practical stuff, was it?
Not entirely, no. That's what's so fascinating. Sure, it solved logistical problems, but it also tapped into something deeper, um, psychological and social needs in early communities. Think about barter, the first step.
Ah, yes, barter. Seems simple, but actually
Hmm.
incredibly clunky.
Oh, massively inefficient. The classic problem is that double coincidence of wants. You need two people who simultaneously want what the other person has.
Exactly. Like, I've got loads of grain and I need an axe. But the blacksmith, he doesn't need grain right now. He needs wool. So now I've got to find a shepherd who wants my grain and has wool to trade and then hope the blacksmith wants that wool for his axe. It's just this long, tangled chain.
It really is. And if they don't have what you need right then and there, no deal. It's seriously put a brake on cooperation, specialization, communities growing.
It wasn't just inconvenient, it was a real barrier.
A huge barrier. So money pops up partly as this, well, ingenious solution. It acts as a tangible symbol for abstract value, something everyone in the group agrees has worth.
Okay, so it fosters trust. Right. It smooths things over where barter just breaks down because my immediate needs don't line up with yours.
Precisely. That shared belief is the key. Holding that early money, maybe it's a shell, maybe a bit of metal, it wasn't just holding an object. It was like participating in a social contract.
A collective agreement. We all agree this thing has value. That's actually quite profound. The power isn't in the thing itself, but in our shared psychology about it.
It really is. And think bigger picture. Money let us move beyond just immediate survival stuff. You could store value over time. You could make promises about the future. It even fueled creativity.
How so? Creativity.
Well, an artisan could spend weeks making a really specialized tool, knowing they could sell it for this accepted money, and then use that money to get whatever they needed later on, food, clothes, materials, not just hoping the person who wanted the tool also had the specific thing the artisan needed right then. It opened things up.
Right. It decouples the immediate exchange. It allows for planning, specialization, innovation, really.
Exactly. It helps defer needs, diversify what you can get. That fueled progress massively.
Okay, but this also plugs right into our emotions, doesn't it? Like the fear of not having enough scarcity, the desire for security, and let's face it, sometimes just wanting more greed.
Oh, absolutely. Money is tangled up with our most primal feelings: fear, security, desire. Understanding that connection is, well, crucial if you want to manage money effectively instead of letting those instincts drive you unconsciously.
So knowing why you feel a certain way about money, like maybe fear makes you overly cautious or desire makes you take silly risks, that awareness helps you make better choices.
Precisely. If you recognize, say, FOMO pushing you towards a risky investment, you can pause, step back, make a more rational decision. It's about moving from being controlled by money's psychological pull to understanding and managing it. That's a big step towards financial mastery.
Okay, so we've established barter was the starting point, but really inefficient. Let's dig into that inefficiency a bit more. That grain farmer and blacksmith example really paints a picture.
It really does. So imagine the farmer, right? Huge wheat harvest, feeling good, but he needs a new plow for next season. Off he goes to the blacksmith.
Make sense?
But the blacksmith says, "Sorry, mate, got plenty of grain. What I really need is meat for the family." Now the farmer's stuck.
He's got to become a middleman. Find a butcher who wants grain.
Exactly. Find a butcher with spare meat who also needs grain right now. And maybe that butcher doesn't even need anything the blacksmith makes. It could be this whole chain reaction of finding people with matching needs. Super time-consuming, super uncertain.
And the value. How do you even decide? How many bushels of wheat is one plow worth? It feels so arbitrary. Depends how desperate the farmer is or how busy the blacksmith is, right? Scarcity must have played a huge role.
Absolutely. There was no standard measure. Every single trade was a negotiation from scratch. What's this worth compared to that? It constantly changed. So much friction, so much wasted effort.
That lack of a standard unit of account, as economists call it,
Yeah.
that's a killer for efficiency.
It's the fundamental problem. And that's what really pushed societies towards needing, a universal medium, something standardized, the first glimmerings of money.
And it's wild how those basic principles, reducing friction, boosting efficiency, are still driving things today, just on a way bigger scale. You mentioned digital payments, global supply chains.
Think about tapping your phone to pay. It's instant, seamless. No haggling over the value of your phone versus the coffee, right? It just works because the value is agreed upon in monetary terms.
Removes all that friction.
Totally. And global supply chains. They're incredibly complex systems designed purely to move goods efficiently across massive distances, overcoming the physical limits barter had. The core goal hasn't changed. Make exchange easier.
So escaping the chaos of barter led us to commodity money.
Yeah.
Using actual goods as currency. What did that look like?
Right. So commodity money is basically using goods that have their own inherent value, or at least are widely desired, as the medium of exchange. Its value wasn't just based on agreement. It was tied to the usefulness or appeal of the thing itself.
Like salt. You mentioned that. Crucial for preserving food before fridges, plus flavor. It had real practical use.
Exactly. Survival value. Or cattle and farming societies, they provided food, milk, hides, labor, immense practical value.
And shells, like cowrie shells. That seems less practical.
Well, yeah, less about survival, more about perceived value. They were often rare, looked attractive, hard to get hold of in large quantities, so scarcity and desirability played a big role. Even tobacco in early American colonies functioned as money for a while.
So the rarity, the difficulty in obtaining them, that boosted their value as a medium of exchange. But it still needed that collective agreement, didn't it? A pretty shell is just a pretty shell unless everyone agrees it's money.
That's the absolute key point. Value isn't in the object. It's assigned by us, collectively. Through social acceptance, that's the constant thread, from shells to salt, right through to, well, digital code today.
We agree gold has value, even though its practical uses are limited compared to, say, steel. We agree that digital token, just computer code, is worth something. It's all about shared belief.
It's the bedrock. And you see that today. Gold, yes. Prime real estate. Even digital assets, it's the same principle. Value assigned through scarcity and collective agreement. The specific items change, but the mechanism, remarkably consistent.
So commodity money was that vital step. It got people used to the idea of a standard value, making trade smoother, and sort of paved the way for more abstract forms later on.
Exactly. It laid the groundwork, introduced standardization, built trust in a medium beyond direct barter, a crucial evolutionary stage.
Which brings us neatly to coins. That feels like a really big jump. Standardized metal pieces. What made coins such a game changer?
Oh, they were a massive leap. Several reasons. One, portability, much easier to carry than, say, a cow. Two, durability. They don't rot or spoil like grain. Three, and this is crucial, standardization. Minching them gave them a consistent weight and purity.
So more trustworthy than just random lumps of metal.
Way more trustworthy. And you mentioned Lydia, around 600 BCE. That's often seen as a key moment.
Right. What was special about what they did?
The Lydian kings started stamping these standardized metal bits, electrum actually, a gold-silver mix with official marks. They're symbols. This wasn't just saying this weighs X amount. It was the king guaranteeing it. It was an assertion of authority.
Ah, so the stamp wasn't just quality control, it was a political statement. My authority backs this coin's value.
Precisely. It built trust in the currency and bolstered the king's power. It was like early branding, a visual promise from the ruler.
That makes so much sense. The images weren't just decoration. They were symbols of legitimacy. Trust this coin because you trust me, the ruler.
Exactly right. It shows how tightly money and governance have always been linked. Financial systems usually reflect and reinforce the power structures of the time.
It really highlights that political angle. Minting coins wasn't just about making trade easier. It was a tool for consolidating power, projecting authority, managing the economy within their realm.
Absolutely. Controlling the coinage gave rulers huge economic and political leverage. They could fund armies, build things, unify their territory more effectively. Big advantage.
Okay, so from barter's chaos to standardized king-stamped coins, that's quite a journey. What's the next big evolutionary leap? Where do we go from metal?
The next huge shift was paper, the paper revolution. And that required an even bigger mental leap, moving from tangible metal value to just abstract symbols on paper.
Yeah, that does sound like a stretch. How do you convince people a piece of paper is worth as much as a lump of gold? What was the thinking there?
Well, it didn't happen overnight. It started with promissory notes. Think goldsmiths again. People would deposit their gold or silver with them for safekeeping because goldsmiths had strong vaults.
Right, secure storage.
And the goldsmith would issue a receipt, a piece of paper saying this person deposited X amount of gold with me. These receipts were easier to carry around than bulky metal.
Ah, I see. So people started trading the receipts themselves instead of moving the actual gold.
Exactly. The receipts started circulating as a stand-in for the gold. They were convenient, trusted, because everyone knew the goldsmith held the actual assets. That was the bridge to paper money and eventually to fiat currency.
And fiat is where the link to physical gold or silver gets cut completely, right? Its value isn't backed by stuff in a vault anymore.
Correct. Fiat currency's value comes entirely from the trust and confidence people have in the authority issuing it, usually the government or central bank. The power shifts from the material to the institutional trust, a massive psychological shift.
But this paper system, this fiat system, it must have offered some big advantages. You said it gave governments more flexibility.
Huge flexibility. Governments and central banks could now manage the economy more actively. They could increase the money supply to stimulate growth during a downturn or fund big projects without being limited by how much gold they physically had. A powerful tool.
But that power comes with risks, surely. Like printing too much money leads to inflation, the value drops. Or worse, people lose faith entirely.
Absolutely. That's the inherent danger. If trust in the issuing authority crumbles, maybe due to hyperinflation, massive debt, mismanagement, people lose faith in the currency's value, it can trigger economic collapse. History's full of examples.
It really highlights how fragile these systems are, fundamentally based on collective belief.
They are. And that brings us pretty much to today. We operate mainly with fiat currencies, promises on paper, or digital entries. It makes you realize how much we rely on these abstract trust systems and the constant effort needed to maintain that faith.
And now, of course, digital currencies are challenging those traditional trust models all over again. A whole new chapter.
Indeed. It's constantly evolving.
You mentioned the gold standard earlier, that attempt to keep a tangible link. Can you unpack that a bit more? How did it work?
Sure. The gold standard basically meant a country's paper money was directly convertible into a fixed amount of gold. The government promised, bring us this banknote and we'll give you this much physical gold.
So my paper money was like an IOU for actual gold held by the government. What was the point? Stability?
Stability and discipline, yeah, that was the idea. By tying money to a scarce physical asset like gold, it was meant to stop governments from just printing money wildly and causing inflation. It also made international trade easier because exchange rates between gold standard countries were pretty fixed. Gold's scarcity and durability were seen as anchors.
Sounds sensible. Why did most countries eventually ditch it then?
The main problem was its rigidity. As economies grew, they needed more money circulating, but the world's gold supply didn't magically increase at the same rate.
Ah, so the money supply couldn't keep up with economic growth.
Exactly. It could actually hold back growth, lead to deflation. And it really tied governments' hands during crises.
Yeah.
If you needed to stimulate the economy, you couldn't just create more money easily because you were constrained by your gold reserves.
Plus, couldn't people panic and demand all their gold at once? A run on the reserves?
That happened too. In times of uncertainty, people would rush to convert paper to gold, draining the reserves and forcing the government off the standard anyway.
So the stability it promised could actually become a major weakness, preventing flexibility when it was needed most, a real trade-off.
A fundamental trade-off, stability versus flexibility. And that exact tension is still central to monetary policy debates today. The gold standard taught some hard lessons about that balancing act.
So now we're firmly in this reign of trust, the fiat era. You said it gives governments power via monetary policy. How does that work in our credit-heavy world?
Right. With fiat money, central banks can try to steer the economy. They adjust interest rates, manage the money supply through things like buying or selling government bonds, that's open market operations, and set rules for banks.
So if the economy is slow, they might lower interest rates.
Exactly. Make borrowing cheaper, hoping businesses invest more and people spend more. If inflation's too high, they raise rates to cool things down, make borrowing more expensive.
And because so much relies on credit now, mortgages, business loans, credit cards, these interest rate changes have a huge ripple effect, don't they?
A massive effect. Credit is really the engine oil of modern economies. It lets businesses expand, people buy homes, it fuels growth. But it also creates complex links and vulnerabilities. If credit suddenly dries up or gets too expensive, it hits everything.
Okay, so in this system, built on trust and fueled by credit, what are the biggest risks we face today?
The number one risk is always that loss of trust. If people worry the government or central bank isn't managing things responsibly, maybe printing too much money, letting debt get out of control, faith in the currency can evaporate.
Leading to inflation or worse?
Yeah, high inflation, maybe people trying to get their money out of the currency or the country capital flight, and ultimately economic instability. There's also the risk that the powerful tools central banks have could be misused or policy mistakes could be made. And as we keep saying, the rise of decentralized digital currencies is now actively questioning this whole government-controlled trust model.
Okay, let's talk about banking itself. From goldsmiths storing gold to banks lending out way more than they actually hold in reserves, it sounds inherently dicey.
It can sound that way, but it's also what allows economies to grow efficiently. Remember the goldsmiths issuing paper receipts for gold deposits?
Yeah, the precursors to banknotes.
Well, those goldsmiths who became early bankers noticed something important. Not everyone came back to withdraw their gold at the exact same time. Most of it just sat there.
Okay, so they realized they didn't need to keep all the gold on hand all the time.
Exactly. They figured they could safely lend out a fraction of the deposited gold to borrowers who'd pay interest, while keeping enough in reserve to handle the usual day-to-day withdrawals. That's the core idea of fractional reserve banking.
And by lending out money they don't physically have,
Yeah.
based on the deposits they do have, they're essentially creating new money through credit.
Precisely. It seems like magic, but that's how it works. Banks create new money when they make loans. This system massively boosts the amount of capital available for investment, fueling economic expansion.
But the risk is still there, right? What if everyone panics and wants their money back at once? A bank run.
That's the inherent vulnerability. If depositors lose confidence and too many try to withdraw funds simultaneously, the bank won't have enough reserves to pay everyone because most of it has been lent out. That can cause the bank to collapse and trigger wider financial panic.
So understanding fractional reserve banking, how credit is created, the growth it enables, but also the risks it carries, that's really fundamental for anyone trying to understand modern finance.
Absolutely critical. Our personal finances, the whole economy, it's all deeply tied into this system of credit and debt.
And trying to manage this whole system, we have central banks. What's their main job, and how much control do they really have? You called it the illusion of total control.
Well, their main goals are usually price stability, keeping inflation low and steady, and promoting maximum employment. They use their tools, interest rates, reserve requirements, buying, selling bonds to influence how much money and credit is flowing through the economy.
So they're trying to fine-tune the economic engine. But why the illusion of control? What limits them?
They're operating in a super complex, unpredictable world. Their actions can have unintended side effects. There are time lags, they pull a lever now, but the full effect might not be felt for months, even years.
And they can't force people to borrow or spend.
Right.
They can only influence the conditions.
Exactly. Plus, they're affected by global events, politics, things outside their direct control. Sometimes a short-term fix can create bigger long-term problems. It's not like they have a precise thermostat for the economy.
So it's more like navigating a storm than driving a car, reacting as much as steering.
That's a good way to put it. They have significant influence, yes, but they're not all-powerful. Recognizing those limits helps you understand why economies go through cycles and why volatility happens.
Okay, let's shift gears to how we interact with money day to day. Digital banking has totally changed the game, hasn't it?
Oh, completely. It's been a revolution. The convenience is incredible. Instant access, transactions anytime, anywhere, mobile apps, online platforms. They've democratized financial services, putting tools in everyone's hands that used to be only for, the pros and the wealthy.
I remember having to physically go into a bank to deposit a check. Seems ancient now. But this convenience brings new risks, especially around security, right?
Absolutely paramount. As everything goes digital, we're more exposed to cyber threats, fraud, identity theft, data breaches targeting both individuals and the banks themselves. Protecting our information online is crucial.
So it's not just about knowing how to use the app. It's about digital literacy, security awareness, understanding the risks, and taking steps to protect yourself.
Exactly. Staying vigilant about cybersecurity is just part of managing your finances now. It's essential for financial well-being in this digital age.
And then came the age of plastic, credit cards. So common now, but they definitely changed spending habits.
They certainly did. Huge convenience factor, right? Making purchases without carrying cash. And used responsibly, they help build your credit score, which is vital for things like mortgages or loans later on.
But the flip side is, it's so easy to spend money you don't actually have or lose track and end up in debt. That convenience is a bit of a trap, isn't it?
It absolutely can be. Useful tool, but dangerous if misused. It's incredibly easy to rack up debt, and the high interest rates mean that debt can snowball really fast if you only make minimum payments. It can become a real burden.
So really understanding how they work, interest calculations, minimum payments, credit scores, that's non-negotiable if you're going to use them.
Totally. Responsible use means budgeting, trying to pay the balance in full each month to avoid interest, and seeing it as a tool for managing cash flow, not just free money or an excuse for impulse buys.
Zooming back out, we live in this globalized world now. How has that, plus the internet, changed how money flows? And where do digital currencies fit in?
Globalization and the internet have made moving money across borders incredibly fast and cheap compared to the past. Businesses operate globally, individuals send money internationally. It's all much more interconnected.
And then cryptocurrencies like Bitcoin appear, operating outside the traditional banks and governments.
Exactly. They offer a decentralized alternative. They have potential for financial inclusion, reaching people without access to traditional banks. But they also come with big challenges. Huge price swings, regulatory questions, potential for illicit use.
So we might be heading towards a future where traditional government money and these new digital currencies exist side by side, or maybe even compete.
That's a very real possibility we're seeing unfold right now. The interaction between these different systems, national currencies, corporate digital payment networks, decentralized cryptocurrencies, is going to dramatically shape the future of global finance.
And technology isn't just changing payments, it's opening up investing too, right? Making it more accessible.
Massively so. Online brokers, investment apps, they've slashed the barriers. Things like fractional shares mean you can invest in big companies with just a few dollars. And robo-advisors offer automated portfolio management that used to be very exclusive.
It's definitely easier to get started. But the basic principles of smart investing haven't changed, have they? Just because the tools are easier doesn't mean you don't need discipline and knowledge.
Absolutely not. Easier access is great, but you still need financial literacy, a long-term view, understanding risk. It's crucial to avoid chasing hype or trading emotionally. Focus on diversification, your own goals, your risk tolerance.
So the tech helps, but wealth building still comes down to consistent, informed decisions over time, not trying to get rich quick.
That's the core of it. Patience, discipline, continuous learning. No real shortcuts.
You know, it feels like our whole idea of what wealth even means might be shifting too. It's not just about dollars in the bank anymore.
I think that's right. There's a growing sense that true wealth includes more than just money. Things like sustainability, social impact, contributing to society. These are becoming part of the equation for many people.
Like green investing, becoming popular, putting money into companies trying to be environmentally responsible. And new tech, like AI or blockchain, is creating completely new kinds of value, often focused on solving problems.
Exactly. The future of wealth might be less about just accumulating capital and more about how finance aligns with purpose, how it contributes positively. Using financial goals to support personal values and maybe even make the world a bit better.
But in our fast-paced world, that urge for instant gratification is strong. How does that mess with our financial health?
Oh, it's a major obstacle. That desire for immediate rewards often leads to impulsive spending, neglecting saving for the future, putting off long-term planning. The short-term buzz of buying something now can easily overshadow the long-term security and freedom that comes from saving and investing.
Our brains want the quick hit. But building wealth needs that long view. Delaying gratification, it's tough.
It is tough. But cultivating patience, valuing that delayed reward, is essential for financial resilience. Saving and investing today, even small amounts, is literally investing in your future self, your future freedom and peace of mind.
And while we're trying to plan, there's this silent thief you mentioned,
Hmm.
inflation, constantly eating away at our money's value.
Yeah, it's easy to ignore day to day, but inflation, the gradual rise in prices, means your money buys less over time. Being aware of it is crucial for preserving wealth.
So just leaving cash in a low-interest savings account means you're actually losing ground.
Pretty much, yeah. Your purchasing power is shrinking. That's why people invest in things like stocks or real estate assets that historically have the potential to grow faster than inflation over the long haul. You need to factor inflation into your planning and adapt your strategy.
Let's dig into why we buy things. What are the psychological drivers behind our spending? It's not always rational, is it?
Rarely purely rational. It's a mix of emotions, social pressure, very clever marketing hitting our desires and insecurities. We often buy things for how they make us feel or how we think others will perceive us, not just pure need.
So recognizing those triggers like FOMO, status anxiety, emotional spending that gives us more control.
Absolutely. If you can identify why you suddenly feel you need that new gadget or trendy item, you can pause and evaluate. Practicing mindful spending means consciously asking, is this a need or a want? What's really driving this purchase? That awareness helps break the cycle of impulsive consumption.
It sounds like building wealth isn't about one big move, but about those consistent, small, positive habits.
That's exactly it. Budgeting regularly, saving consistently, reviewing your finances periodically, these are the building blocks. It's the power of compounding. Small, steady actions add up massively over time.
Like a snowball rolling downhill. And you mentioned designing your environment to support your goals. What does that mean practically?
It could be simple things. Automate your savings so the money goes out before you can spend it. Unsubscribe from tempting marketing emails. Maybe even spend more time with friends who have sensible money habits. It's about setting up your routines and surroundings to make the good choices easier and the bad choices harder. Discipline and consistency beat occasional big efforts every time.
We've covered so much ground, from ancient barter to modern fintech. It really hammers home how vital financial education is for everyone.
Absolutely essential. Understanding the basics, interest, taxes, credit, investing, empowers you to make informed decisions in this complex system. You can't navigate it effectively if you don't understand the rules of the game.
And it's not a one-and-done thing, right? The financial world keeps changing. It's lifelong learning.
Definitely. You have to stay curious, keep learning. The more financial knowledge you have, the more control you have over your own future, the better you can adapt to whatever comes next.
So as we wrap this up, it feels like the real meaning of wealth goes beyond just the numbers.
I truly believe so. Real wealth involves aligning your money with your values, your life goals. When your finances support your sense of purpose, that's where deep satisfaction comes from.
Using money as a tool not just for yourself, but maybe for your community, for causes you believe in.
Exactly. Aligning financial power with purpose. That fosters lasting happiness and lets you build a meaningful legacy. It's about making a difference, however big or small.
So when you peel it all back, money isn't just neutral stuff. It's this complex web of psychology, history, and trust. And understanding those deeper forces like we've tried to explore today, that's what really empowers you to make better financial decisions, decisions that work for you, and maybe even align with a bigger picture.
And that really brings it back to you, the listener. What's your relationship with money? How has hearing about its evolution maybe shed light on your own beliefs or habits? Thinking about that connection between money's history and your own psychology can be incredibly insightful. It can help you shape your financial future consciously, maybe finding ways for your finances to reflect not just your needs, but your values too. How does money's journey reflect our own journey as humans? Something to ponder.
Thanks for taking this really deep dive into the fascinating world of money with us.